Now, before we get into this, we'd like to remind you, please like, share, subscribe. Your support is always appreciated. So this is where we look at, what is the aggregate? And this is where we talk about gasoline, jet, distillate, and residual. And here you can see kind of that sloppy up, down, up in terms of just where we were following Colonial, some of those movements, because Colonial moves really all 3 out of 4 of those products. So that takes time. And that's what we keep talking about, trying to get all the way through. And now we really come to the end of that movement, and we'll start to see some of this balance out. So the current level was 15.281 million versus last week of 13.331. So clearly you have that big delta, and it's going to be somewhere in the middle. And if we average it out just over the last 4 weeks, we're currently sitting at 14.678 million. So that's where just, we're not at that 15,000 level, 15,000 barrels a day, but, just below. We're still going to trend higher. It's just going to be at, we're going to have a little bit of a reduction back below that 15,000, but again, not by a huge amount. So that's where we start getting into 14.8, 14.9 million as that average movement. It's still going to be below the last, 17, between 17, 18, and 19. But again, getting closer to some of that normalcy as we go through the remainder of June. And when we look at distillate, this is what we keep talking about with some of the levels in general. So when we look at disti, it had a draw of about 1.02 million, bringing us to below the 5-year average by 8.7 million. But as we showed with the 29-year, very much above that average. But still, again, this provides opportunity for refiners to run a little bit harder and use a heavier slate because they have spare capacity in distillate storage. And that's when we look at Pad 3, where Pad 3 had a draw of 2.31 million. Still 3.4 million above the 5-year average, but again, there's still that movement, especially when you look at Europe, where Europe is starting to pull in a little bit more diesel, starting to get a little bit more activity. We see additional flow coming from Asia into Europe, and this is something where we'll also see a little bit more of a pull from the U.S. on the distillate side that we haven't seen in the last 12 months, really. So when we look at imports were up 181,000 barrels a day, still well above seasonal average. We typically don't get diesel cargoes at this point in time. They can be spotty, they can be one-offs, but it's been a very steady import side, and it's always coming into Pad 1 because Pad 1 still has the steepest shortage when we think about where the product is, because Pad 1 is 10.2 million barrels below that 5-year average. So again, there's still that excess capacity that can be used, which is why they're trying to take advantage, especially given where some of the spreads are in the market, and we have a lot of that Asian product that has come into the Atlantic Basin, and now it has a decision where is going to be the best metric? Is it going to be in Europe or the U.S.? And it'll sell into those markets to try to optimize margin. So then when we look at demand, you can see that you had that big drop, big spike back up. Now it's something where it'll drop, but it's not going to drop back to that 5-year average. It'll just drop to about the top of the cloud. So we're still going to be at about, I'd say, almost 4 million barrels a day in terms of where we are. So it'll be a drop, but not a steep drop down. It's just going to be more of that kind of that balancing out, because we do still have a lot of trucking demand. We still have a lot of rail demand. So we still have a ton of cargoes coming through the LA port. We hit over 1 million cargoes, which is a big number, and we'll talk about that in a minute. But again, these are things that are going to be supportive of the distillate side of the equation. And here's where you get some of that balancing act. So you see the trucking index come down, but the load availability is starting to come back up, and you're going to see that balance out. Now, the issue is going to be this balancing of, well, what are rates doing? And here you can see over the last, since 2020, we've had this just steady grind up, and now we're actually seeing this acceleration point of rates going higher because diesel keeps getting moved up. And you're starting to get a little bit of rejection of like, maybe I'll wait, maybe there's some rail capacity I can piggyback on. And that's why we're starting to see some slowdown. But it's not a huge slowdown. It's just again that kind of steady, balancing act between one and the other to try to just protect against pricing, because when we look at prices, they remain so aggressive against PPI, against CPI, against import-export prices, things that we're going to talk about in the economy show tomorrow. And then when we look at, and I know everyone's excited that the economy show's back, but yeah, that's something that we're going to talk about in greater detail on Thursday. And then when we look at rail, here's where you can kind of see where rail sits. Still remains robust. Intermodal continues to be a bright spot. Some of the things that have calmed down a bit on the motor side, on the non-metallic, but petroleum and petroleum products is going to stay stable at this point. We don't see it being a huge increase, but again, we see that kind of stable move, especially with Colonial back, some of that catch up that has already been done. But the one that is going to continue to be robust is grains, forest products, farm, steel containers and lumber containers. In terms of movements, those have continued to be robust. It's a means of trying to normalize the system. So steel and lumber is going to continue to be that supportive side, especially on the rail end. Here's where, when we look at just what is happening in the Port of LA, you're continuing to see that strength. Even though it's down versus previous week, it's up against previous year, previous 2 years, and there's always 1 week in this 3-week time frame that you see this massive surge that then gets spread out because we continue to have the backlogs, we continue to have that congestion, and it's increasing. And one of the things that we're going to talk about in segment 1 of the Econ Show is what does China look like? How bad are some of those port congestions? Because we continue to see that being a big factor in some of the normalcy or lack of normalcy that we're struggling to see within the supply chain. On the weather side, things have normalized a bit. For those in the West Coast that have been experiencing some massive heat waves, a lot of that will still continue, but we're starting to see some of that shift where you're getting some of that Arctic air coming south. And not that I'm a weatherman, but just to give you an idea, this is just going to be where does natural gas pull come through. Coal prices remain very strong, which is just being highly supportive of LNG moving into the international market. LPG moving into the market. So that's where we continue to see propane and natural gas demand into the export world, remaining, providing opportunity for E&Ps to make money, not just on oil, but as well as the liquids and gas side. Then when we look at just what's happening in gasoline, here's where we continue to have these steady builds overall. So we had a build of 1.95 million. We're now 1.2 million barrels a day, barrels above the 5-year average. Pad 3 continues to be that point where it's 5.5 million over the 5-year. And now Pad 1 is back positive. And the reason why it continues to be, when we look at it, imports continue to be elevated, 275,000 barrels a day over the 5-year average, still holding above that million. So we were expecting a drop to about 960,000 barrels. This is timing. So now we'll probably have a bigger drop this coming week. But again, it's still going to be elevated. It's still going to be strong. We still have that flow through from Europe, and that's going to continue. Now, here you can see we typically have some of those builds when we look at the 29-year average, and that's why it's important to look at 5-year, 29-year, understand where our historics are. So we typically get a little bit of that build. And then as we come into July 4th, then you see that acceleration through July, that continues into September, and then things in September, Labor Day kind of being that pivot point is where things go sideways. So we continue to have a very strong rate of change, in increase. As we showed in the first segment, this is the second highest gasoline storage has been since outside of 2020. So these are things that continue as we're seeing those additional cargoes continue to come from Europe, from the Middle East, from Asia into the Atlantic Basin, and then ending up into the U.S. But On the other side, gasoline demand continues to have that trend up, and that's what we've been saying is you're not going to get this huge explosion higher. You're just going to get things a little bit this little increase, little decrease, and we're just going to kind of stay within this level. But we still expect to see a little bit higher highs, a little bit higher lows, and this movement up on a week-over-week level, just because this is summer driving season. People have either graduated, going to graduate, coming into that period, and that's where we continue to see. And speaking of which, so according to Gas Buddy, the prior week was up 0.8% from the week prior. Again, just below 1%. Now, could we see, a 0.5% decline? Yes. Could we see a 0.2%, 0.3% increase? Absolutely. But it's going to be within that margin of error as we go into the July 4th weekend. And it's the competing sides of, well, why? Well, gasoline prices continue to surge higher. As we were saying, we were expecting to be at $3.05. We're now at $3.07. That is, again, that becomes a much bigger issue as people are struggling, and we'll talk about in segment in the Econ show. Where is inflation? Where are wages? How much is this impacting people's activities? And then when we look at diesel fuel prices, here you can see, again, up another penny to $3 and almost 29 cents. And that's where we were expecting to stay around that $3.27, $3.28. It's probably going to get closer to $3.30. And this is why you're seeing some of that friction with, obviously, trucking demand is still well above all-time highs. But when we look at it in terms of within 2021, you're still well off the peak, closer to kind of where that trough was. And that's the competition, is how expensive is diesel? How are you trying to manage your supply chain? And then that gasoline price is going to continue to weigh into, okay, well, how much do I have to drive? Can I cut some filling up to try to save some of those pennies? And that's going to be something to consider. And then, as we always talk about, the blending components continue to have these very large builds. And the most recent build was of 2.59 million. So it was still above, again, that gasoline side, and you had a build of 4.1 million over the 5-year average. So we're continuing to see those blending components build. And that's why when we talk about the stack and the way the refiners are cracking oil, they're going to have to get a little bit heavier, try to maybe take some of that, use that in other regions to adjust some of those blending components. And then as we see the adjustment with RINs, what does that mean with the EPA waivers, which have since expired? So you'll see some of those blending sides, but having the blending components where they are also enables them to import a bit more because you have that excess blending, but we continue to see this trend up. And just given where current runs are, we expect to see these trends continue with those builds coming through. Then when we look at the last 5 years, obviously taking out 2020, when we look at the demand level, we're right back to the base where we had this big drop off in 2018. And then you had that big increase. So again, you always have that waffling up and down because it's implied demand. So it's the supply, again, the supply chain when it leaves from point A to go to point B. And that's why you always have some of that lumpiness. So this is the one that is going to drop, but we're not coming back to the lows. It's just going to be a kind of that measured drop, something closer to about 9.1. Just based on where we are in that timing game in terms of where that demand is and where that overall demand sits going through the rest of June. Then when we look at propane, the pace of builds has slowed down again. It was only a build of 1.54 million, still 8.1 below the 5-year average, still well within that 2017 movement. Prices remain elevated, and even with prices elevated, you're still seeing that export demand, which is going to allow for stronger prices because we're just not going to see this big acceleration in storage, which is going to support that liquid cut, NGL condensate cut, which again is going to be that positive for some of those completion activities. Now, when we look at activity levels, the transit stations, people are starting to get a little bit more comfortable with the transit. In New York, they just lifted some additional mask mandates. There's still one for transit, but again, we're getting to that point of vaccinations where people are feeling a little bit more comfortable taking transit, especially if anybody's been on the Grand Central. It looks like the U.S. Air Force got confused, carpet bombed the road, and then to fix it, they just haphazardly paved over it. So it's just a nightmare in terms of construction, and again, so you have people that have forgotten to drive over the last 6 months of staying home, construction that wasn't done when nobody was on the road, and just there's inherent just people that don't want to be on transit. So you have the increase in traffic, you have terrible roads, and people that forgot how to drive equals not a lot of fun to be commuting. So you're starting to see some of that come through. Parks have obviously gotten back up. That's something that obviously is going to stay elevated. And when we look in China at China, we're seeing more people stay local in China. And not to say that we're not going to see travel increase in the U.S., because we will. It just won't be to the same level as I think expectations as we continue to see, and we have some additional data points on that in segment 3. The Apple trends, you continue to see that movement up, and now we've gotten into this normalcy level as people look to get back to normal in terms of Europe, the US. But again, the sideways move is kind of what we're expecting at this point in time. And some of the positives, a lot of these vaccination rates remain elevated. There hasn't been too much acceleration or deceleration. On the deceleration, that's obviously even better. India is the one that remains concerning because it's still a very slow pace given the amount of people that are in the country. So that's something that we'd like to see increase in general. Europe remains on a very strong path. Again, all of these things are net positive in terms of getting people back to and feeling better about their situations. And then when we look at the percentage of people that have been vaccinated, so fully vaccinated, you can see that we're continuing to trend higher. India, again, only at that 3.4%. We would like to see that higher. The U.S. is at 44%. The problem now, and we're seeing, people being incentivized from $100 referrals and all types of means of accelerating this pace. There's about 25% of the, 25 to 35% of the people that have been polled that say, look, I don't want to get it. I don't feel comfortable getting it. And we're starting to approach that level. And that's where I think you're going to start to see that slow down. And that's another thing that's going to keep U.S., COVID cases fairly flat. And we saw it in the UK because the UK is only at 45%. So you kind of saw the UK continuing, and now it's started to get a little bit of a creep higher. We could see that in the US, but it won't be all that meaningful, just given you do have a lot of vaccinated, you do have people that already had the disease. So again, there's still a lot of positives to be had here. So then when we look at jet, jet fuel had a build of 1.28 million, up 3.9 million above the 5-year average. And as we were saying, we expected to see kind of that a bounce off the bottom, and as we were saying, we weren't going to make a higher high, but just kind of split the difference, like right in the middle. We're going to continue to see us work between that level. And if I had to bet on next week, I would say that demand is probably up a little bit more. I don't think it takes out this high, but when you look at the seasonal component, typically you get this dip as you come in, and then you get this big explosion in demand. If we look over the last 4 years, obviously taking out 2020, but even in 2020, you saw this big surge as we went into June, July. So we typically get that big bump. So we'll get that move up. It's just going to be obviously on the muted level. And the reason why is because, again, we're just not seeing departures really increase. When we look at on a world level, it's essentially flat. It's actually slightly down. And it was pulled down because the U.S. has flatlined. Asia Pacific continues to be under pressure. Even as Europe and the rest of the world continues to come back a bit, it's the Asia Pacific that continues to see that whittle down and be that overhanging pressure. And here's where we continue to have that, that seasonal trend up. You can see that in 2019, we kind of had that steady trend higher. We continue to do that. It's just the pace has been a little bit stronger on the bottom side. We continue to have a similar move versus 2019 on that steady higher high. the benefit for us right now is we're still getting those higher lows. So we're getting that little bit of a tighter band, a bit more bullish to the upside, which is the net positive. And then when we look at OpenTable, we remain firm that the weekends will be flat to up. Things will be much better on the weekends. And then the weekdays will kind of continue to be that underperformance where, if anything, if I had to say, we'll probably be 0 to 5% better than previous on the weekends, and about 15% below normal on the weekdays. And that's something that we continue to see play out over the really the last few weeks. So now we talked about the U.S. In the next segment, we're going to go deeper into what are U.S. exports doing, what do we expect them to do, where are spreads right now, and what does that international market really look like.